Following the announcement that the SAB Zenzele Kabili BEE scheme will be listing tomorrow, the investment case for broad-based black economic empowerment schemes is back in the spotlight. Empowerment share schemes have largely been seen as a good investment opportunity that not only offers investors good returns, but also helps drive transformation. Nastassia Arendse spoke to Craig Gradidge, he's the co-founder at Gradidge Mahura Investments, about the history of the investment vehicle.
In 2006, there was a lot of excitement around multi-choice's Putumanati scheme, as well as the Media 24 Valco Mizani scheme. So those schemes attracted over 100,000 investors, particularly the Putumanati scheme. And from there, it seemed to gain a bit more traction. The next scheme that came to market was SAB Zenzele. And I think that one really got the market excited. And there we saw over 360,000 investors participating. So I think in 2008, with the SAB Zenzele scheme, was probably when you saw a lot of traction in the market and a lot more people talking about these BEE deals.
I mean, they sound exciting, and I suppose the main question is, are BEE schemes for everyone?
Yes, so BEE schemes are for investors who are what they call qualifying individuals, and those are individuals who are defined in the Broad-Based BEE Act as black, so that's African, colored, Indian, and then subsequently Chinese people who have been here for a certain period of time. So provided you meet the criteria set out in the Act, you would then qualify to invest in these shares.
What would you say, I mean, from your experience in terms of what one should be looking for or what questions one should be asking if they're trying to figure out whether which BEE schemes offer the best prospects?
Yeah, I think trying to identify the best prospects or the best kind of return outcome is a very difficult thing to do up front. I think investors need to understand, their own risk profile and their own objectives, and basically find the schemes that fit into that. So, for example, if you tend to be a bit more of a cautious investor, you don't like the use of debt, then Putumanati and Sasol's SABC scheme would be more attractive to you as an investor because those schemes do not have debt. However, if you're a young investor starting out and you're looking to try and build your balance sheet a bit faster, then you can afford to take on risk. And some of the deals like Yebo Yetu with Vodacom's deal, or MTN's Akele Futhi, or even the two Ukamba deals, those shares have quite a bit of debt embedded in them, and therefore can give you a much better return over time. Remember, the more debt that's in there, the higher the exposure you have to the underlying asset. So effectively give you a much bigger exposure than if you try to buy those shares directly outside of the scheme. So again, depending on your own circumstances and your own risk tolerance and your ability to take on risk, it would then push you to, one share over another. But I think the important thing is to look at which company you're investing in. Ultimately, that's going to determine the success or not of a particular deal. So, a company like Vodacom, MTN, SA Breweries or AB InBev with the new Zenzele Kabili deal, those are much bigger companies compared to Ukamba, which is invested in Motus and Imperial, which are a bit smaller, although they are sizable companies in their own rights. So you got to look at where am I investing? What is the business I'm buying into? Then the other important thing is to look at the funding structure. So how have they capitalized these deals? How much debt is in the deal? How much equity? And as I say, if you risk intolerant, or if you think that interest rates will go up by quite a lot, you're going to want to avoid those that have a lot of debt. If you want dividends from your investment, then the likes of Putumanati and Yebo Yetu generally pay the best dividends. So automatically that would guide you in the direction of those two particular shares. So there's quite a lot to consider. The important things are what is the fundamentals, or what is the attraction of the underlying business that I'm buying into, and then how risky is the funding structure. Those are the key questions that you've got to ask yourself.
Before I let you go, are there any lessons to be learned from recent BEE schemes, whether it's from the point of maybe one successful one that you can think of and one that may not have performed as well?
Yeah, I think the most important lessons with these deals is that you've got to invest for the long term. So over the years, what we've seen is that the returns from these deals tend to be quite lumpy. And what that means is that, you can go for a long period of time without getting any return. And then in a matter of a few days, you can make, 50, 60, 100% return. So a lot of your return can happen very quickly. So if you're not invested before those events, what they call liquidity events, or some kind of corporate activity, then you can miss out on the bulk of the return. So the important thing is to invest and stay invested. I think trying to calculate or determine which would be the best performing deal, I think that's a waste of time. Apply the principle of diversification and invest in several of the deals, so diversify your risk. And then also I think it's important to remember, if you look at African banks, two deals, Eom Klaba and Hlumisa, with those deals, because African Bank almost went under, so the business was put into curatorship with the Reserve Bank. Investors in those two deals lost all their money. So it's always important to bear in mind that you can lose your entire investment. So that's the risk that you're taking. However, if you diversify and if you're careful about the shares that you choose, I think over time you can still make a very good return from these investments, provided you stay invested and you invest in the really well-structured deals and in good underlying businesses.
Right, my colleague Nduduzi Mthembu is standing by with you with a deep